The smartest guys in the room who blew up the world.
In 1998, a single hedge fund brought the global financial system to the brink of collapse. The people running it were two Nobel Prize-winning economists, a former vice chairman of the Federal Reserve, and a team of elite mathematicians from MIT and Harvard. To understand how they did it, you have to look at Wall Street in the late 1970s and 80s. The bond market was a casino, dominated by aggressive, instinct-driven traders. John Meriwether, a quiet, numbers-obsessed trader at Salomon Brothers, hated relying on gut feelings. He only bet when he had calculated a specific, undeniable edge. Meriwether formed a new group at Salomon and filled it not with traditional speculators, but with PhDs. Wall Street called them quants. Meriwether called them his edge. They set out to construct a machine that systematically dismantled the concept of risk itself, using pure mathematical equations. When Meriwether left Salomon to start his own fund, Long-Term Capital Management, he assembled an intellectually intimidating roster. He hired Robert Merton and Myron Scholes, the co-creators of modern option pricing, along with David Mullins, the sitting vice chairman of the Federal Reserve. No hedge fund had ever amassed that level of academic firepower. This diagram illustrates their core strategy: arbitrage. The computers would scan historical data to find two similar bonds that were slightly mispriced relative to one another. They would buy the cheap bond, short the expensive one, and simply wait for the prices to converge. The profit on each trade was practically microscopic, often just fractions of a cent. To turn those fractions into fortunes, they applied the second part of their equation: extreme leverage. The partners convinced major banks to waive standard collateral requirements, allowing them to borrow $28 for every single dollar they actually held. They were trading on borrowed money without putting their own capital at risk. By combining thousands of mathematically certain micro-profits with massive amounts of borrowed cash, they created a massive financial engine that delivered immense returns while appearing completely immune to normal market hazards. Long-term capital management opened its doors in early 1994, and almost immediately the chaos of the bond markets played perfectly into their models. In 1995, the fund returned 59% before fees, and by 1996, they were managing $140 billion in assets. One single position, a massive bet that the yields on Italian government bonds would eventually align with German yields, generated $600 million in profit for the fund. The ultimate intellectual validation arrived in 1997, when founders Robert Merton and Myron Scholes were at the Nobel Prize in economics. The market had crowned them as the men who tamed risk. But the success that earned them that prize was destroying their business model. Every major bank on Wall Street had started copying their trades. The tiny price gaps their computers relied on were vanishing. The math was right, but the opportunity was gone. To maintain their massive profits, the fund began drifting away from the carefully hedged bond arbitrage they understood perfectly. They started pledging billions of dollars into complex corporate mergers and selling enormous amounts of options on the S&P 500, betting that overall market volatility was priced too high. Then, in mid-1998, with the Russian economy showing severe strain and interest rates skyrocketing to 120%, one of LTCM's lead traders went outright long on Russian government bonds. It was a naked, unhedged directional bet based on a single assumption: nuclear powers don't default. On August 17, 1998, Russia defaulted on $13.5 billion of debt and devalued the ruble. Their highly sophisticated models had calculated the probability of this happening as effectively zero. This animated graph displays the terrifying reaction across multiple global markets. Investors panicked, dumping anything with an ounce of risk to buy safe US and German bonds. Because every market moved in the exact same direction simultaneously, every spread plunged. In a single Friday, the fund lost $553 million, 15% of its capital. As their equity vanished, leverage spiked to 55-1. The robust historical data they had fed into their computers simply lacked the one variable capable of breaking the entire system: an entirely irrational, synchronized global panic. The market was entirely frozen. There were no buyers for the complex instruments LTCM held, and because the partners had been shopping their portfolio around looking for a savior, their Wall Street rivals knew exactly what positions they were stuck in and actively traded against them to push prices down even further. the partners furiously dialed every major billionaire they knew, George Soros, Michael Dell, and Warren Buffett, begging for a private rescue. Nobody was willing to step in. By mid-September, officials from the Federal Reserve Bank of New York reviewed the fund's internal risk documents. What they found terrified them. LTCM held over $1 trillion in complex derivative exposures, directly entangled with the balance sheets of every major bank on Wall Street. If the fund went bankrupt, every one of those banks would instantly scramble to seize their collateral and dump assets at the exact same moment. It was a perfectly designed, highly leveraged explosive that threatened to entirely freeze the global financial system. The Federal Reserve took an extraordinary step. They summoned the heads of 14 bitterly rival Wall Street institutions into a single boardroom and engineered a $3.65 billion bailout. The banks injected the cash, but in exchange, they took 90% ownership of the fund. The geniuses at LTCM lost their vast personal fortunes, their control over the company, and their standing as the smartest men in finance. This bell curve demonstrates the fatal mathematical flaw in their logic. Standard financial models assume that extreme, market-breaking events are so mathematically rare they might not happen in 1,000 lifetimes. But real markets have fat tails, meaning those catastrophic, outlying events actually happen every few years. When a true crisis hits, all the historical correlations that tell a computer how different assets should behave simply vanish. In a panic, human beings abandon logic and sell absolutely everything they can, all at the exact same time. The partners at Long-Term Capital Management believed they had successfully mapped the financial world into a perfectly rational, risk-free equation. But they were destroyed by the one variable they left out: the chaotic, unquantifiable force of human